We go. Aloha, everyone. It's Gary Moores here with Coldwell Banker Island Properties. I have Kelly Polly from Creative Financial with me. Hi, Kelly.
Hello, aloha.
Kelly, you've probably done, gosh, I would say in the last 5 years, at least 20, at least 100 transactions, probably about 20 a year for me.
Oh,
Um,
yeah,
yeah, and
couple
she's,
hundred actually.
yeah, and she's batting 1,000 for me. Kelly's been great. So I asked her to join me because things are changing a lot, and I just wanted to see what's going on with the finance world and inform all of you that are out there in the public. So, Kelly, I'm just going to kind of leave it open. You know what's changed and what's new. So why don't you start with what's going on with the finance world and on condos and houses these days?
Yeah, so I wanted to just share some temporary guidelines that Fannie Mae and Freddie Mac put into place during this really unusual time. We're
Okay.
experiencing a lot of stay-home orders in the different counties and states.
Hmm.
And so a lot of people would naturally think that lending might be a lot more difficult. To be fair, there's not anything different in lending today as it was 2 months ago. However, they have added sort of a relief temporary guideline package to make our process easier and also respecting the stay home order. And so I just wanted to share that with some people that might be
Sure.
interested.
Please.
Yeah, so the first thing is I want to address the big elephant in the room. There are many, many people that have experienced layoffs or
Hmm.
temporary furloughs, or some people have reduced hours. I know some companies, half staff will go in this week and the other half will be off for the week, and they'll be, switching hours. And so, you know, the income and guideline rules have not changed, and they have not yet made provision for that. And as always, if you are working, whatever hours you're working, that's how we can use to calculate income. So to answer the question is, if I have been furloughed temporarily, could I qualify now for a refinance? The answer, unfortunately, would still be no, just because it always was no. And I'm not sure if we're going to see loosening on that end. I hope that they do, but for now, on a normal refinance, there's nothing we can do about that.
Okay.
And before I get too much in the woods, on the same hand, though, if you have a mortgage and it's Fannie Mae or Freddie Mac owned, they are giving a 90-day forbearance to people already that have been affected by the COVID-19. So you can look into that, and I'll give information to you, Gary, that you can post on your media sites.
Okay.
But you would basically go to fanniemae.com or freddiemac.com. There's a lookup tool. You put in your information, and if they have your loan, then you can request a 90-day forbearance. They're also going to freeze the credit reporting, so they're not going to report to the credit bureaus that you were either late or not paid for 3 months because you took the forbearance. So that's really cool, aside from a new refinance. Going back on the new refinance, if you are still working, if you're essential and you're working, and you closed in the last 5 years, it's likely your rate's around 4.5 to about 4.8. That's where a lot of the lenders and loans were in the last 5 years. You could be in position now to try to obtain about a 3.5 or lower if it comes down to it in the next couple months. And with the new refinances or even purchases, you would be able to take advantage of this sort of temporary guideline relief. As an example, number one, normally we need a full appraisal, Gary. We have to
Hmm.
go in and we have to show the lender the collateral. The collateral is the property. What does it look like? What's the condition? How many bedrooms? What are the square footages? And those things. And right now, an appraiser would normally go into the home to take these photos. They have suspended, in most cases, no one in the home. We don't want an appraiser going into someone else's home and potentially spreading the virus. So Fannie Mae and Freddie Mac have made provision for appraisals for drive-by onlys. And so that's really nice. It makes it actually quicker turnaround for the appraisers and
Right.
getting the appraisal reports. And I would say that if you're in a transaction now or you're considering one, and that is the case, you want to remind them, Gary, whoever's showing the home, whether it be a refinance and it's the owner or the seller's agent, since they're not doing an actual showing or going inside, then you want to make sure over the phone you gave the appraiser all of the upgrades and all of the information that you did in the home, so that that's not missed when he's calculating value. That's a very important key.
I would imagine he'd also appreciate video or photos if you had them, right?
Oh, most definitely. Yes, most definitely.
So the owner could actually do his own video or take photos for the appraiser.
Yep. Yep.
Okay.
So that's really important. The other thing is right now they are actually reducing the type of employment verification because they know people are trying to do work from home and they're not physically coming in. Usually we have to do what's called a verbal employment verification right before the loan gets funded, right before it closes. And we realize the HR departments just may not be in. They might not be in the office, they might be at home. And so they are doing a streamlined exceptions for reaching at the end a verification of employment. There are multiple other options that they're allowing to be done instead of that, last minute phone call at the very end, because they realize there might not be people to answer the phone.
Interesting.
Yeah, it's pretty cool.
So you think if somebody got laid off, that might get missed?
So they're still confirming it, just not as close to closing. They usually call the day before funding. They're starting to implement that 10, 15 days prior. So if at that point they were verified and maybe they got laid off, it potentially could get missed. The lender is really depending on, obviously, honesty and transparency all the way through. The other thing that we're doing, just as an added layer, because we want to help people, whether it's through a new refinance by lowering the rate permanently or by helping them get a forbearance temporarily with no pay. Either way, we want to position ourselves to help them, but we want to make sure we help them the right way. So if they did just get laid off, a new loan may not be the answer. The answer might be a no pay, because what's not going to happen is if they get the new refinance and then it's time to make the first payment, they won't be eligible for the no pay. And so we do try to keep in touch. I had one deal 2 weeks ago. They signed closing docs the day before funding, right before this whole thing happened, and they just laid him off due to the COVID-19. The lender was very accommodating. They gave him a free lock extension. They gave him 3 weeks. He's an essential. Luckily, in his field, he's an essential. And in a week and a half, just actually last Monday, he got a job. And we've got the lender back revisiting, re-verifying, and we'll probably sign him by the end of the week, and we'll close within that period. So they were flexible. They didn't cancel the deal. They didn't say, oh, too bad, start over. So they're being flexible in that area.
Okay. Yep. So how about purchases? How many purchase loans have you written in the last couple of weeks?
Let's see. I've probably only, I would say I've seen 2 things. I probably have maybe 3 new contracts in the last 5 days, about 3. Okay. And I would say that's a little slower than normal, but I would say there's 2 kinds of people that I see that are looking right now very, very aggressively. The people who have been waiting and looking for homes, they've been on the fence, they're essential medical field, government workers, and they do see this as an opportunity for them. They realize that, 90% of the world is laid off right now. And so it's eliminating that buyer frenzy and sort of counter wars with purchase prices. And so they see it as an opportunity. And so they're aggressively looking now. I have the other group of people, the investors who maybe over the last several years have paid off some of these investment properties. They're coming to us asking for cash out refinances. And they want to use this cash to position to pick up properties in the event we do see some softening in the values. And so that's what I'm kind of seeing right now. And
interest rates are interesting. I mean, it is a good opportunity for buyers right now because, like you said, number one, there's less competition.
Mm-hmm.
And number two, aren't the interest rates lower now than they were?
Yeah, so I love interest rate history. And so if I
Hmm.
may geek out a little bit on you right now.
Sure.
So let's see. I would say the first time I ever saw rates really go through the floor for the first time was around September 11th, when, we had the travesty of the
2001. Hmm.
2001 Twin Towers. And they
Right.
kind of went down in Florida at that time. And then they did it again in one summer. Something was really rallying, and the market had kind of fallen, and we got it. It was in June, 1 June. I think it was like 2000. I want to say 11. It really bottomed out, and then we kind of circled back up to the last couple of years. And for the first time in history, they went to as low as 3%. We had a little bit of that last year, a really tad, and then we saw it at the very end of this February, the first week of March. In some scenarios, people were getting about 3%. And now when I say 3%, Gary, to clarify, I'm not talking, I'm talking base rate. So if you had less than 20% equity, a lower credit score, a condo versus a home, these other add-ons that would normally be, I'm talking base rate. And so I've seen that a few times. And so what happened is they originated so many loans in that first week of March this year, 75 million new applications in our country just in
Oh
the
my
first
gosh.
week of March. Yeah, we
Wow.
were pretty busy. That the lenders swung that rate, and in 1 week, that second week in March, that base rate went from almost three, a little above 3 to 4. It swung up a whole
Wow.
point in 1 week. And so here we are in the second week of March, and they're like 4.125, the base rate. And then now here we are, April 15th, and the base rate's about 3.6, 3.7. So they've
Right.
softened, and it's got to come down with this
Yeah.
crisis we're in. Rates will
So
come
you're not
down.
recommending people lock their rates right now. You're just getting the process started.
Well, I'm gonna tell you what I recommend. I recommend, if you already right now today can bring your rate down a full point, you definitely should get started now.
Hmm.
Okay, get it in, get it submitted, start the process.
Right.
Because I don't have a crystal ball, and because after 20 years of lending, you think you know something and then you realize you don't. I
Right.
wouldn't want to tell people not to lock in, because if it never does soften, they would have missed out on saving money right now. And
Hmm.
if we're being honest with ourselves, we're always looking for like a better deal, but
Hmm.
sometimes it doesn't come. And so my true professional recommendation is, if you can save a few $100s now, you may want to consider it.
Right.
As long as you're bringing your rate a full point down, as long as you can recoup the closing costs in less than 24 months,
Okay.
then you're kind of good to go now, or at least get started and then watch, locking in.
All right.
That would be my recommendation.
So it's pretty easy math. You just take a look at what your new payment would be,
Mm-hmm,
calculate the costs, which you're required by
mm-hmm,
law to provide right away as soon as they apply,
mm-hmm.
right? So you look at the
Yeah.
cost, divide it by the savings. If that answer to that equation is 24 or less,
Mm-hmm.
then do it. Okay,
Yep.
got it.
And as you're shopping around, refinances should be about 5,000, closing
Total
costs all
cost.
included. Yeah, shouldn't be
No
more than
matter what
about
the loan amount?
5,500. It doesn't matter what the loan amount is. You can't add your taxes and insurance. If they're going to collect that and put that into your loan payment, you can't add whatever they're collecting to include in your loan payment. That's not closing costs. Those are collecting your insurance and taxes ahead of time.
Sure.
So when it's due in 3 or 4 months, they have your money. So not
Right.
including the prepaids, true closing costs, title, escrow, appraisal, the underwriting fee, that all should be within the $5,000. Nothing more
Okay.
than that. I had a client call me this morning, and they went online. We all tried it. Go online, get to one of those online fast lenders that don't have a presence in Hawaii,
Right.
and they were quoted about $10,000 in closing cost.
Cool.
And so I said, as a friend, I'll look it over for you. Send me what they got, and I'm like, no way, less than $5,000 closing costs. It shouldn't be
Yeah.
any other reason.
They might have teased them with a slightly lower rate, but when they're doubling their closing costs, it's not a good deal. Yeah.
When I looked at it, they had thousands and thousands of dollars paying points to get the rate down to the 3.6.
Oh,
And,
wow. Yeah.
yeah. And The other thing is we have a local lender. I won't say who because, if you want to obtain that great rate, you got to come through me. But there's a local lender and they're trying to grab some of this market right now. And they've dipped their base rate better than any Fannie Mae lender right now. I priced a refinance today, 3.25%, but with 3/4 of a point. But 3.25 for less than a point. Now that's a good rate. It's just a regular single family, no cash out. They have lots of equity, 800 scores. So that was a better case scenario. And that person asked the same question. Do I wait or do I lock in? Their current rate is 4.6. So I said, well, it's your choice. This is something you always have to decide, but you're saving like $550 a month. Are you willing to risk that for no savings if it doesn't go the way you think? And that was a question they had to answer.
Okay. There's something else that I noticed. I was looking I think it was in the newspaper where I saw that the 15-year rate was actually a little higher than the 30-year rate. We must have an inverse, what do they call it, yield curve, inverted yield curve. So is that still the case today?
Let me pull up real quick. I haven't seen it today, but I've been noticing though it's been almost flat. And while I pull that up, another thing I'll address is the 5-year ARM. So when the feds lowered the short-term securities rate to 0 a few weeks back, mind you, they had already reduced it 4 times last year. Coming into the new year, the short-term security rates were already just 0.25%. So it went from 1/4 to 0. And what that did is it aggressively lowered the adjustable rate mortgages because those are based on the short-term security rates. Right. So for people who know they're going to get this inheritance or they're going to maybe sell this house in a few years and they don't need that 30-year term, they really have been eating up those 5-year ARMs. And that's where it's a 30-year fixed, it's a 30-year loan. It's amortized over 30, but it's only fixed for the first 5 years. And that's been very aggressive.
Yeah. Yeah, I did one of those 10-year fixed on my home. And then when the rates got really low, I just refinanced it. I got a 2.75% 15-year fixed rate. So
good job.
I never want to refinance that one again, man.
Yeah. You're good for the rest of your life.
That's right. So do you have any information on 15-year fixed right now?
Yeah. So I'm looking at it now.
Okay.
You know what? So it's I pulled up about 3 different lenders as we were chatting. Right. 2 of the lenders, the 15-year fix is about 1/4 better.
Okay.
And then, so just only 1/4 apart, which is not a lot for a 15-year.
Right.
Usually it's a little bit more dramatic. And then one of my favorite local lenders, they're 0.5 point different.
Okay.
Yeah. So.
Right. So it might make sense if you want to have your home paid off sooner and you can afford it. Why not go for a 15-year and save 0.5% a year?
That's right.
That's not bad. Yeah.
Right.
Anything else you want to add about the world of financing? How about condotels, short-term vacation rentals as opposed to investment property as opposed to owner-occupied? I know they all have different levels, requirements for down payment and that kind of thing. What has that changed at all?
Yeah, well, so last year, one of our favorite local lenders really aggressively made a statement in our market and said, we know that these condos allow vacation rentals. We know that they have front desks. We know that some of them have timeshare. We know that, 80 to 90% of the usage in these projects are short-term rentals. And Fannie Mae and Freddie Mac says, nope, we won't lend on those condo projects. So prior to last year, in order to get any kind of loan, no matter how you occupied it, typically you needed a minimum of 30% down. Other lenders were 35% down, and one particular local lender wanted 40% down. Well, last year, one of the local lenders says, hey, we'll take most of that market. We will allow primary residence and second home occupancies 20% down. And that was really shocking from an original 30% down to a 20% down. So that's still the case. Nothing's changed.
20% if you're going to buy loans, as long as they don't do vacation rentals, right?
Yeah. So if you're going to move into it or have it as a second home, you can buy a condo hotel with 20% down.
Okay.
But if you do want to participate in the vacation rentals, no problem. But then they want the 30% down.
So this is interesting. So something like, say, Kihei Akahi, where they've got a front desk, they're managing short-term vacation rentals. As long as you call it a second home or a primary residence, you can get in with 20% down now.
That's right. And
All right.
let me give you the definition of second home.
All right, that was my next
question.
question.
The definition of second home is all you have to do is have the intent at the time you apply for second home financing. You have the intent that you will visit it a minimum of 14 days a year. And there's nothing extra added. You can't do this afterwards. You can't do that. It just says your intent is to utilize it a minimum of 14 days a year. That's it.
It's pretty easy. And so you can still rent it out, collect income with only
so
a 20%
they don't say
down.
You can or can't. And so that's kind of out there to, your own, decision, as long as you can commit that you will utilize it with personal use a minimum of 14 days a year.
Okay, that sounds like for most vacation rental property buyers, a pretty easy task to accomplish. All right, so if you're an investor on a non-vacation rental property, same thing, 20% down?
So if you are an investor and you cannot commit to the 14 days, or if you're an investor and you need help with the rental income from the unit you're buying to help you qualify for the loan, then it's considered non-owner investment, and they want a minimum of 30% down.
Ooh, okay. So it doesn't even matter if it's a condo-tel or not. What matters is if you need the income to qualify, sounds like.
Yep. Well, but an investor can decide to buy, let's say, Kihei Villages. That's a conforming project. An investor can buy there at 15% down.
Really? Wow. And use the income, the net income for qualifying?
Yep. So Fannie Mae got really aggressive a couple years back, and they're now doing non-owner investment financing, minimum 15% down.
Wow. So this is all new. Gosh, I'm glad I had this call with you.
But those are not for condo hotels. Those are only for conforming condos or homes.
Okay. Now, when you say conforming condos, is there
no vacation rentals allowed in the project? You can't have more than 15% of the owners currently behind in their association dues. There's kind of a list. You have to have the.
Sure. So it passes a scrutiny on the condo questionnaire, I suppose.
Yeah.
Okay. And now the gazillion-dollar question. Primary residence, but you don't have a lot of money or have almost no money in the bank. Can you still get a loan?
Yes. Okay. They're still intact. We have the zero down program, which is USDA. You can have the seller maybe credit the closing cost. You come in with zero down, and all you need in the bank is 2 months of the new monthly payment. So if your new monthly payment is $2,500, you got to scrape together $5,000, and it's got to just be sitting there. Seller can pay closing costs, no money down. You're good to go.
Okay. I assume those 2 months worth of monthly payments have to be seasoned, have to have been in your account for a while, or?
They allow paychecks as long as it came through on a paycheck. So we had a client that had, let's say, $3,000 in her bank account, and right before closing, she got paid again because she lived at home. She wasn't paying out rent or using the funds. So before we closed, we could verify the 2 months.
Oh, that's good. Or I suppose a gift letter from the parents or something like that would also be.
Gifting is acceptable as well.
Okay. Wow. So it sounds like it's pretty easy to get financing right now. Still, they're doing what's needed to make sure that there's no fraud, I assume, right? All of those new rules that came in after the 2008 debacle still apply. So they have to be giving you their actual tax returns and then sign a form that says that you or the lender can check to make sure those are actuals. They're probably checking seasoning on bank accounts to make sure the money's been there for a while. They're doing all those. There's probably still the lottery choosing the appraiser, right? So that the vendors cannot choose an appraiser.
That's correct.
Yeah. All the good things that are protecting our American banks from fraud. So that's good. Yeah, but they are making it a little easier for homeowners to become homeowners, or for people to buy investments too. That's awesome information. Wow, Kelly, that's great. So I think that that's a good amount of information for now. But what I
Okay.
the most one of the most important things next for you to share, I think, would be how do people get a hold of you so that they
Oh,
can get the financing going if they want to do
sure,
that.
sure. Yeah, so I own a brokerage in Kihei. It's called Creative Financial,
Okay.
and our website is creativefinancialhawaii.com. And we're really easy. We're all over the internet, and we have a great website. You can apply right online. I
Hmm.
also love doing phone interviews. Gary, that's another real quick thing I'll end with, is a lot of people think, oh, I've got to find 100 documents and have that ready before someone can pre-approve me. We really try to make it easy for you. And I
Hmm.
personally do all of my phone interviews less than 10 minutes on the phone. I'll ask you questions before you send me one document. And I can
Okay.
already tell by the phone interview if it's 90% there or not. So I'll kind of help you determine if you're ready before you start digging through paperwork. And we try to
Sure.
make it real simple.
That's
Yeah.
good. And then all they have to do is later show you the paperwork that supports
Yep,
what they've told you over the phone.
that's
Yeah.
right. We give them the time to trickle the paperwork in after I've already kind of given them the green light, and then we
Right.
work together to get it ready before you make an offer.
Yeah. Okay. That's great. Well, Kelly, I know you've done phenomenal work for so many of my clients, and I'm so thankful for that because not only were they able to get into a home, but I was able to collect a commission check, and I'm always happy about that when that happens.
Awesome.
But it is really a thrill to help people get into their homes, and you've been a big part of that. So I appreciate you all for all these
Well, thank
years,
you.
been able to help so many people, and hopefully together we'll be able to help a whole lot more people in the
All right.
future. And so
Well,
I
thanks for
appreciate
having
you.
me. And
Yeah.
I just want to say, like, I really enjoy working with Gary Moores as well, because if you really want a fighter on your side, if you really want a professional, if you want a seasoned person that's going to have your best interests at heart and that will be able to navigate through the intricacies of a purchase contract, Gary, you've been phenomenal. I've watched you do your thing, and it's been a pleasure working beside you. So thank you.
Thanks, Kelly. It's feeling is mutual. Well, everybody, that's it for this time. And thanks again, Kelly. Thanks all of you for watching, and happy hunting. Have a great
Yeah.
day.
Sounds good.
Aloha.
Bye.
Bye bye.